Hello, ladies and gentlemen. I hope you are fine wherever you are. I am Jerem Kulu. I welcome you all to this lecture on short-term decision making. This lecture is part of a series of risk and uncertainty or decision making topics related to performance management. So it is going to be useful for you if you are preparing for the ACCA performance management exam or other similar exams. So without wasting much of your time, let us get straight to business. Now, it is usually a norm that managers are not only going to be confronted by long-term decisions, okay, or long-term decision-making scenarios. They are sometimes obliged to come up with viable solutions for short-term periods. All right. So in this particular topic or this particular lecture, we are going to touch on those issues on how managers are going to come up with viable solutions or applicable decisions. All right. There are certain terms, ladies and gentlemen, we need to understand so that as we proceed throughout the topic, nobody is going to be left behind. We have got what are called sunk costs. Sunk costs are normally historical costs or the costs which have already been incurred or have already been settled. All right, so they are not relevant for decision making. They have already been incurred, so we can't consider them in the current problem. Then we have got what are called relevant costs. These are the costs which are relevant to a particular decision or a particular problem. All right. You might think of this as a cost which should be considered. All right, a cost which should be considered. So automatically you can see that sunk costs, sunk costs are not relevant costs, period. All right. So a relevant cost is a cost that is applicable to a decision, all right, which is relevant, which is linked to a decision. So usually short-term decisions are actually bound or have to be considered or managed using the relevant costing principle. All right, relevant costing principle. And the fundamental of this principle is that the cost should be incremental. So once again, relevant costing is another way of or another form or an expansion or extension of the marginal costing principle. All right. If you understand marginal costing very well, you're not easily going to be lost along the way. Okay. There is what is called opportunity cost. An opportunity cost is a form of a benefit sacrificed or foregone. All right. A benefit sacrificed or foregone when we take another course of action or an alternate course of action, we are going to lose some benefits, and those benefits are an opportunity cost to us. So if we are obliged to come up with a costing of a product, all right, or of a particular service, then we have to consider those lost benefits as part of the cost of making this current or this new product. All right. Then we have got what are called incremental costs. Incremental simply means extra, okay? Extra or additional costs. All right. So these are any extra costs which would be incurred as a result of the decision. Okay. So incremental costs, by their definition, they are also relevant costs. But We also need to understand what are variable costs. We've spoken about the marginal costing principles, and we say that they are the cornerstone of this relevant costing area. All right, so variable costs, these are the costs which tend to vary with the level of activity. Then we have got what are called fixed costs. Fixed costs, they are usually not going to be changed with whatever level of activity we are at. All right, for example, rent is always going to be paid even if we decided not to produce anything this month. By the end of the month, the landlord is going to ask for his rent. So fixed costs, they are normally not relevant to a decision. Similarly, the normal salary of an employee is not going to be a relevant cost when we are talking of a new contract or a once-off contract. Okay, so we are not going to consider the normal salary of an employee who is going to be paid whether we do that contract or not. So such a cost is irrelevant. Okay, then there is contribution. We know contribution is equal to selling price minus variable cost. Okay, selling price minus variable cost, we get contribution. All right, so the contribution per unit is the difference between the selling price and all the variable costs per unit, or alternatively, the profit before charging any fixed costs. So if we have sold an item and incurred a variable cost, we get what is called contribution. This is contribution towards covering fixed costs. Okay, contribution towards fixed costs. All right, so which means our fixed costs should actually be lower than the contribution for us to have a profit. Otherwise, if the fixed costs are higher than the contribution, we are doing nothing, we are just playing. Okay, there are also costs which are avoidable. Okay, although they are fixed, but these ones tend to be avoided. All right, so if we do not make a certain action, we can avoid those fixed costs. Then such type of fixed costs are actually relevant to the decision. All right, I think we should do this example to illustrate the point. A company manufactures 3 products: PLs, rolls, and bands. The present net annual income for these is as follows. We've got the information for PLs, for rolls, for bands, and the total. Then there is sales less variable cost, and we get our contribution, and this is the line for the contribution. And then let's fix the cost, and we arrive at a profit. Okay, I'm sure, ladies and gentlemen, you can appreciate that. This is simply an issue of typing. Okay. Okay, I rectified that. All right, so as you can see, those are the figures which we have, and as I have already pointed, if we say sales less variable costs, we arrive at the contribution. All right, and this was our contribution line. And then if we deduct the fixed costs, these are the fixed costs, we arrive at the profit. But as you can see from the information, the rows are not performing well because they are having a loss of $3,000. So the company is considering whether or not to cease selling rows. It is felt that selling prices cannot be raised or lowered without adversely affecting net income. 5,000 of the fixed costs of rows are direct fixed costs which would be saved if production is ceased. So the fixed costs of about 5,000 could be saved if we do away with the rows selling business. All other fixed costs will remain the same. All right, that's the first part of A. And then part B is saying, suppose, however, that it were possible to use the resources released by by stopping production of rows to produce a new item, closets, which would sell for 50,000 and incur variable cost of 30,000 and extra direct fixed cost of 6,000. Consider whether the company should cease production and sale of roles under each of the scenarios in A and B. So that's the information, ladies and gentlemen. You're given the first information there, the first part of the question, where the company is simply considering doing away with the role selling business, all right, and just continue with the other businesses. In that situation, we are told that some fixed costs could be saved. The fixed costs which are directly linked to the rose selling business, and those are actually relevant costs. Okay, they are relevant costs. They are relevant to the decision of whether we should continue with the rose department or with stopping it, whether we should consider stopping the selling of rose. Okay, so let us try to come up with the decision making criteria. All right, like I said, these problems are linked to marginal costing. So if you are confident, or if you can master marginal costing, then you are at an advantage. All right, but anyway, most of the work has been done. We have got the contribution, ladies and gentlemen. We have got the contribution, which I said this is determined by sales less variable cost, and we arrive at the contribution, as you can see there. All right, so if we close the rose business, there is a contribution that is lost along the way. So lost contribution is a relevant cost. Okay, it is a benefit which we have sacrificed. So it's some form of opportunity cost. All right, that's some opportunity cost in the form of lost contribution. All right, and I said contribution is just a profit a business makes before considering or before accounting for its fixed costs. All right, so that's selling price minus variable cost. So for the rows, if we go to the information there, let me try to erase the other data there. Okay, these annotations. All right, you can see that the contribution for rows was 15,000. So if we close this business, we are going to lose that 15,000. So the 15,000 is a relevant cost. Okay, but we are going to have some benefits if we close this business. There were certain fixed costs which were linked to this business alone. So the 5,000 here is a relevant cost saving. So it's a saving. So savings on fixed costs. Although we know that fixed costs are generally irrelevant, they are relevant when they are directly linked to a particular decision or particular problem. In this case, if these fixed costs are directly linked to the rose selling business, so they are relevant. So the savings we get from that decision is 5,000. Okay, so we also have to consider other facts. All right, we know we are already in a loss-making position. That has ignited us to consider whether we should continue with this business or not. Okay, but we must not be distracted with that fact. All right, so far the relevant costs or relevant incomes have been considered so far as for part A. So we can actually say we are done, and we have to find the sum here, and we are still in the negative 10,000. All right, so the negative 10,000 is determined. If we close shop, if we close the rose shop, we are going to result in a negative position of 10,000. Okay, the final loss is 10,000 versus our present loss of 3,000. So it is actually better to continue with the rose business for now. Okay, so in A, we are better off in just continuing. Maybe the rose is actually a strategic commodity which is supporting the sale of the other two products. So in this case, we can consider continuing producing the rose as we are in a position which is better off. Okay, now what about when we are exposed to the circumstances in part B? All right, in part B, we are told that suppose, however, that it were possible to use the resources released by stopping production of rose to produce a new item, closet, which would sell for 50,000 and incur variable cost of 30,000 and extra direct fixed costs. Shall we then consider closing shop for the rose and produce this new product? Okay, which is a very, very, very good question. Now, one thing you have to appreciate is that the situation in B is still continuing from the situation in A. So it means that much of the working which we have done so far is still applicable. So for part B, we can say, we can just copy and paste lost contribution. Okay, if we sell this, if we close shop, we are going to lose the same contribution. Okay, 15,000 is going to apply. The cost saving is also going to be the same. Cost saving 5,000. Okay, everything is still the same. However, we have to consider certain issues here. All right, this new product would be sold for 50,000 and incur variable cost of 30,000. So there is new contribution here, contribution or additional contribution to 50,000 minus 30,000, and that's 20,000. Okay, so additional contribution which we can get, additional contribution, we're going to get 20,000 more. All right, but we are also told that there is an extra fixed cost which we will incur if we start to produce the closet. So additional fixed cost of 6,000. This is an outflow. All right, so we need to add up these figures to see if we are going to sustain again a loss or a gain. So 15 minus 5, that's 10, negative 10 minus 20, we have got positive 10, minus 6, we are in a 4,000 gain. All right, so this is called net gain. So in this case, we can safely say we should close shop and utilize whatever resource that was in this particular department and continue with the new product. All right, what about this particular example? Let us go through it and try to see if we can make sense out of this presentation. An information technology consultant firm has been asked to do an urgent job by a client for which a price of 2,500 has been offered. The job would require the following. All right, so this is what we are normally going to encounter in an exam. All right, some form of real life scenario. Okay, so there is this information technology consultant firm which has been approached, okay, to do an agent job, right? So normally a once-off job, all right, at a price of 2,500, all right. But this job will require the following: A, 30 hours of work, okay, 30 hours of work from one member of staff who is paid on an hourly basis at a rate of $20 per hour, but who would normally be employed on work for clients where the charge out rate is $45 per hour. All right, so the normal charges, okay, or the selling rate of this guy's services is normally at $45 per hour. All right. No other member of staff is able to do the member of staff. No other member of staff is able to do what this member of staff is capable of doing. Okay, that's it. There is a typo there. All right. So there is no other member of staff who is able to do what this particular member does. All right. We are also told the use of 5 hours of mainframe computer time, which the firm normally charges out to external users at the rate of $50 per hour, is also required. All right. Mainframe computer time is currently used 24 hours a day, 7 days a week. Supplies and incidental expenses are of $200, which are also required for this particular job. Okay, so those are the facts, ladies and gentlemen, and we need to determine the relevant cost for this particular job. All right, and we are told from the first line, if we try to go systematic, we are told that we need to cost the labor. All right, let me just try to fit everything on this corner. All right, because if I continue doing to other pages, that might also distract you, might distract your comprehension and your attention. So let us do it on this page. Of course, the workings might be a clutter, but I'll try by all means to ensure that you guys are given a clearer view. All right, so we need to cost the labor cost. All right, the labor for this particular job. All right, 30 hours of work are required, okay, from a staff member who is paid on an hourly basis at a rate of $20 per hour. So we are going to meet this cost, ladies and gentlemen. All right, so that's 30 hours multiplied by 20, okay, and this gives us $600. And then we need to finish this statement. But who normally be employed on work for clients where the charge out rate is $45 per hour? But in this case, if we take this guy from those clients who give us almost about $45 per hour of this guy's services, don't you think we are losing something? There's no other member who can replace this guy. All right. So if we take him to do this current customer's work, we are going to lose some contribution, okay, or some revenue. All right. So revenue lost, you can safely say opportunity cost, okay? Opportunity costs in the form of lost revenue, obviously. In the form of lost revenue, because if this guy does work to these other customers, he's paid $45, but in this particular contract, he's going to be paid $20 per hour. Okay? So we are going to multiply by the 30 hours above. and we should get our 750. All right. So we need to cost that lost revenue. We have to recover it from this current job. We have to recover it. All right. We have to recover it. Okay. Then part B is saying the use of 5 hours of computer time. So we need to consider the computer time. Our computer can be used for free. Okay. So the computer time has to be incorporated. Okay. We normally charge how much for this computer? We charge $50 per hour. All right. So we are going to say $50. What's going on with my pen? Multiply by 5 hours, and we should get 250. Okay. So the reason why we are charging here is because the computer time, the mainframe computer time has no spare capacity. It is being used 24/7. All right. So we have to charge. But if there was some extra capacity, then because we want to remain competitive, there was no point for us to include those hours where there is some spare capacity. All right. Then supplies and incidental expenses which are relevant to this job of 200. So the supplies and expenses of 200. So these ones are the costs which are relevant to this particular job, ladies and gentlemen. So if we add them up, we get our $1,800. This is the cost of the job. So the relevant cost or opportunity cost of the job is $1,800. Okay, I hope here we are in agreement. Okay, sometimes you as a manager, you may be confronted with scenarios where you have to come up with a make or buy decision. So in order to overcome problems of limited resources, a firm may buy in a product instead of making it by itself. All right, sometimes it is cheaper to just do everything in-house, or sometimes to buy from outside, right? So where incremental costs of manufacture are less than those of buying in, the firm should make, assuming that there are no limited resources. Where resources are limited, where resources are limited, the firm should concentrate on making those products which give the greatest saving over buying in per unit of the scarce resource. So you can see that the make or buy decisions are also linked to what we did cover some time ago of key factor analysis. Or limiting factor analysis, okay, or binding constraints, something like that. Okay, remember when we did those throughput accounting, those key factor analysis topics in our initial weeks. Okay, so where resources are limited or are scarce, therefore, the firm should concentrate on making those products which give the greatest saving or over buying in per unit of scarce resource. So to decide which products should be made and which should be bought, we calculate the saving per unit of scarce resources. Per unit of scarce resource from making the product rather than buying it in. So let us go through this example to see if we are getting something at the back of our heads. The availability of material B is limited to 8,000 kg. Okay, so we have got only 8,000 kgs in stock. Demand in units we have got 2,000 for product X, 2,500 for product Y, and for Z, 4,000. Buy-in price, that is the price if we are to buy these commodities or these units from outside suppliers, we are going to be charged $13 per unit. But if we make them inside, there is a variable cost of $10 per unit, right? And we have already agreed that variable costs are part of relevant costs, all right? And the buy-in price is also part of a relevant cost in considering our decision. However, it only becomes relevant in its savings, in the consideration for savings. Are we going to save anything? Okay, if we buy, all right. So the relevance is in the gain we get, all right. And in terms of quantities of materials, we are told that product X, if we are going to manufacture it inside or in-house, we are going to require about 3 kgs to manufacture product X, and then 2 kgs to manufacture product Y, and a kg to manufacture product Z. All right. So if you look from a layman's point of view, you can see that in terms of quantities, actually it is easier to produce Z first when it comes to the quantities involved, okay? The quantities that would be required to manufacture these items. Z actually takes small quantities, okay? It requires small quantities to manufacture, all right? But that is not the case when you have to make managerial decisions. You have to go a step further and analyze these situations using some applicable frameworks. All right. So we need to be systematic, and we have to lay our data in a tabular form, because the question is saying which products should the company make and which should it buy. All right. So let us try to imitate the table. We've got product X, product Y, product Z. Okay, these are the 3 products, ladies and gentlemen. So we are told that the cost of buying in for product X, we are told that they require $13, and this one $17.16. So 13, 17, 16. There is also the cost of producing, cost of making. Okay, cost of buying in or cost of making the product, and there is this variable cost which is relevant, ladies and gentlemen. So 10, 12, 14. Okay. So, like I said, the relevance is in the saving of it, okay, the cost savings. So, if we buy from outside, or if we make from, if we make in-house, all right, we are going to save. If we make in-house, there is a saving, okay, saved cost or cost savings, all right, per unit. All right, for product X, we are saving $3. If we make in-house, other than buying outside, then we are saving $3. Okay, if we make the product, we are going to save $3. But in situation Y, as for product Y, we are going to save about $5. Okay, we're going to save $5, and here we are going to save $2. All right, so these are in dollar terms. And then we have to argue now these cost savings, how much are they in terms of the scarce resource? And we are told that the materials for this product, which we have, is just 8,000 kg. So our stores are only having 8,000 kgs of this product. Of the materials to produce these products. So we are restricted by materials. So we need to determine the savings per unit of scarce resource. And the unit of scarce resource in this case is kgs, materials in kgs. So the kgs now, we need to consider the kgs of materials. All right. The kgs of materials are as given in the question. Okay. We are just being led by these. These are the figures, ladies and gentlemen. All right. How much kgs are required in each product or to produce each product? We can see that X requires 3 kgs. This one requires 3, this one 2, this one 1. All right. And savings per unit of scarce resource, and we know that the scarce resources are these kgs, are the materials. So savings per unit. So we can see that the cost savings per unit was $3, okay, but the cost saving per unit of scarce resource is now $1 for product X, but for product Y it's 5/2, that's $2.50. For product Z, you can see that the saving per unit is $2. So from this, you then have to do what you learned before, the issue of ranking products. We have to rank the products to see which product should be given preference of manufacture ahead of others. So you can see that from this, we can see that product Y should be manufactured first. If there are any other leftovers in terms of materials, because materials is the limiting factor. So if we still have got other materials, we then have to produce product Z second, because these are the products which gives us the highest saving in terms of this line. The highest saving is in product Y, that has got $2.50, followed by Z, which has got $2, and then X should be produced last, which only gives us $1 advantage. After you do that, or after you establish that, you then have to come here and say production plan. Production plan. All right, the production plan, ladies and gentlemen, is guided by our demand. By the demand, there is no sense, there's no purpose. Even if a product is giving us the most, the highest saving, we have to be guided by the demand, because we need not to produce things which are going to be stocked in our warehouse. That would create some custody costs, okay, or storage costs. We don't want those. So we are guided by the demand levels. These are also a limiting factor. Demand is also a limiting factor. So we then have to say, from this we can see that Y, which we should produce first, we are restricted to 2,500. So we say units, and we need also to have the units in terms of demand. This is demand, okay, and then we have to know kgs in terms of materials. All right. So we are starting with the product Y. All right, and we know the demand for Y is 2,500. Okay, and each product or each unit of Y requires how many kgs, and from the information here, we can see that Y requires $2. Okay, so this guy requires $2. So all in all, we need 5,000 kgs for material, of material to produce product Y. So we are left with how much? Remember, we are guided by the quantities available of material, which are 8,000. Okay, so we are left with 3,000. So we have to say product Z, which is going to be produced next according to our ranking order. We say that Z is going to be number 2. So Z, how many shall we produce? The demand for Z, according to the question, is 4,000 units. Okay, and each unit requires 1 kg of material. So if we produce all the 4,000 units at 1 kg, we have best our budget, because we are restricted to only 3,000. Only 3,000 is the balance. We only have got 3,000 kgs of material. Okay, and each product or each unit of Z requires 1 kg. So automatically we can only produce 3,000 in-house. Okay, we can only make 3,000 with the available materials. So this is how you have to proceed. Okay, so these are the items which have to be made, to be produced or to be made in-house. Okay, 2,500 of Y and 3,000 units of Z. So this means that we need to buy, therefore buy in, we need to buy in because the demand for Z, we know that the demand for Z is 4,000, but we have already manufactured 3,000 as shown above, as you can see there. Therefore, we should buy 1,000 units from outside. Buy in Z 1,000 units, because our demand in total is 4,000. So you can just say 4,000 minus 3,000, so that the markers will see what you are talking about. Okay, and as for product X, you have to buy in. For product X, you have to buy in everything. The spelling of buy in there, I'm not happy with it. So buy in X. How many units? The quantities you have to buy in for X is it should be determined by the demand. So buy in 2,000 units. Buy in X 2,000 units. Or of them, according to demand. According to the demand. Okay, that's how you were supposed to proceed with the problem. Okay, but you might also be confronted if you are in the manufacturing environment. You may be confronted with the situation where you have to determine if a joint product should be processed further. All right, you might be confronted with such a situation, and when you are confronted, you mustn't show the managers that you are confused and you don't know what to do. All right, so ladies and gentlemen, when you are talking of joint products, these are it's an extension of process costing. Okay, there are certain companies who are involved in continuous processes. All right, so we have got this process. Let's say it's an oil refinery business. Okay, this is the process. Okay, which is a joint product. A joint process for these products, and then at this point, one of the product, let's say E, is manufactured, and then F is also manufactured. these products are called joint products if they have, if their values is comparable. Okay, if their value is comparable. Let's say we've got another product here which we can say D. D, in terms of the cost per unit, or yes, in terms of its value per unit, or the cost per unit is, let's say, 30 cents. The cost of producing D is 30 cents per unit. And then the cost of producing E is $4.50. And then the cost for producing F is $3.80. Okay. Let's say E was, we can say this E was diesel, and F was petrol per gallon. Okay, and then D was paraffin. Okay, so what happens is, if you look at these products, you can see that diesel and petrol, or E and F, are comparable in value, in terms of value. Okay, they are actually worth the same thing. They are comparable. But when you look at the price of paraffin, you can see that its price is substantially low. Okay, the price of paraffin is substantially low. This means that paraffin is a byproduct, whilst diesel and petrol are joint products. Those are the items which we covered in our previous management accounting exam. All right, but I'm just recapping them here for the benefit of your revision. Now, the question is, there might come a situation when you are required to present to the board of directors whether we should process further this, one of these joint products to come up with a virtually new or different product. For example, we have already processed diesel and petrol, but we feel there is need to refine this petrol further to something called Jet A1. Okay. The decision for you, the decision is whether it is going to profit the company. Is there going to be some value addition in terms of profitability or cost saving? All right. So the decision is actually going to be based on the advantage the company is going to sustain. All right. After we do the further processing. All right. So a joint product should be processed further past the split off point if the additional sales revenue exceeds the relevant post-separation costs. All right. So remember, this is the separation point. Okay. So any further processing of a joint product should be based on the evidence that the sales revenue, the additional sales revenue, exceeds the relevant post-separation or processing costs. If there is no benefit, we should not consider do the further processing. We shouldn't do further processing as a way of being charismatic or showing all individuals in the industry or in the market that we are risk takers. We should take what is called calculated risk. All right. So we shouldn't just do things for the fun of it. Okay, let us do this last example and see if we can rest our case nicely. Paradise Chemical Company produces two joint products, alumine and palladium, from the same process. Joint processing cost of 150,000 are incurred up to the split off point, and I've indicated that the split off point is this point. Okay, joint processing costs of 150,000 are incurred up to the split off point when 100 units of alumine and 50,000 of palladium are produced. So in a pictorial view, we are seeing a situation like this. We are having a situation where we are having these two products. There is alumine. There is product alumine and palladium. Excuse me. These are the two products, ladies and gentlemen, and joint processing cost of 150,000 are incurred up to the split off point. So up to this point, we have incurred 150,000. Okay, so that's where we talk of joint costs. But we are also told that the units which are produced at this point, at the split off point, were 100,000 alumine. So these are 100,000 units and 50,000 units of palladium. Okay, what else? The selling prices at the split off point are $1.25 per unit for alumine and $2 for palladium. So the SP is $1.25 for alumine and $2 for palladium. The units of alumine could be processed further to produce 60,000 units of a new chemical, alumine plus, but at an extra fixed cost of 20,000. So we can process further this product alumine, okay, at a and we can produce 60,000. So if we process further the 100,000 units which we have of alumine, we end up having 60,000 units of a new chemical called alumine plus. But we are going to incur an extra fixed cost. This is a relevant cost. The extra fixed cost is a relevant cost of 20,000 and variable cost of 30 cents per unit of input. This is unit of input, not unit of output. So you are considering the input here is the 100,000 units from the joint product. From the joint, the split off point, okay? From the split off point. These are the inputs for us to manufacture alumine plus. For us to manufacture alumine plus, we must have alumine first. So alumine is an input of alumine plus. So this is why the examiner has actually been very lenient here. In the real exam, you are not going to be told anything about the variable cost which is going to be incurred is going to be charged on input. No, you really have to know that if we are processing further a certain product, that product which is being processed further is the input of the product that is going to come out. Okay, the selling price of alumine plus would be $3.25. So the question is, should the company sell alumine or alumine plus? Should the company sell alumine or alumine plus? This is the exam question. So excuse me, we then have to come to the drawing board and say, you guys, all right, let me just use another pen. All right, we have got the alumine here. All right, and the Almond Plus. These are the two products which we have. So we need to consider the issue of profitability. We are told that the decision whether to process further or not should depend on the extra revenue. I mean, on the incremental revenues. Okay, if the incremental revenues exceed the relevant post-separation costs, then we are in a better position to come up with such a viable decision. So we say sales, okay, the total sales for Almond. The Almond is the selling price at the split off point. Okay, at the split off point, we are told the Almond is being sold at $25. And how many almonds do we have? We've got 100,000 at split off point. There were 100,000 units. So obviously the revenue we have is 125,000. But as for the Almond Plus, we have 60,000 units, 60,000 units multiplied by the selling price. The selling price was $3.25. So $3.25. So if we punch this figure into our calculator, we get 195,000. We then have to say, do we have to incur any costs if we process further? Yes, we are told that there are some extra fixed costs and some variable costs of 30 cents per unit. So the extra fixed costs, we are told these were 20,000, and they are only applied to the further processing part of the question, where it is linked to Almond Plus. So the 20,000 is affecting Almond Plus, not the Almond. Okay, let me put that demarcation there so that none of us is going to be lost in the jungle. Okay, and then we are told of the variable cost per unit, which we are going to incur. Variable cost per unit was how much? The variable cost per unit was 30 cents. Okay, 0.3 multiplied by the number of units which are going to be input in this particular process, 100,000 units of Almond. Okay, the 100,000 units of Almond. All right, let me just try to write these figures at their relevant place, because I'm foreseeing danger. All right, so we are talking of 30 cents multiplied by 100,000, and we are talking of 30,000. Now, if we have this information, we then have to come up with the profits. Okay, we are having 195 minus 20, that's 175, minus 30, 145,000. And here we are still having our 125,000. All right, so you can see from the look of things, that if we work with the Almond Plus, we are much better off. Okay, we are better off than if we are only selling the Almond. Okay, if we stop at the Almond stage, we are going to get only 125,000. But if we process further, we're going to get 145,000. So there is a gain of 145 minus 125, that's 20,000. Okay, this means we have to further process. We have to further process Almond into how many plus. That's the decision which we can make for now. Okay, I hope, ladies and gentlemen, we have been helped in terms of basic theory and these relevant costing issues. But I think it is going to be very beneficial if we do a real past exam question to see if what we have learned has been processed and become a good product within our hearts. So let us just get a question paper, a past question paper from the ACCA to see if we can come up with something tangible. All right, let me just look for this paper. Okay, ladies and gentlemen, I hope I found this paper. This is from the ACCA December 2011 paper. Okay, there is this particular question, ladies and gentlemen. I want you guys to go through the question. Okay, this first question on telephone call. All right, just go through the paper. All right, if you don't have the paper, if you don't have the question, I advise you to just click on the link below. Okay, just click on the link below and then you get the paper, the question. All right, this is the information, ladies and gentlemen. It's quite a very, very, very daunting and long question. All right, so because of the CBE environment these days, such questions are not common. All right, but we just have to do the question. All right, let me just try to resize this so that you can see the question easily. Okay, let us hear from the requirement. Okay, we just want to do the part A, which says prepare a cost statement using relevant costing principles. All right, relevant costing principles. And we have just discussed those principles in our initial attack of the lecture. All right, and by now you guys are now well versed on what these relevant costing principles are. You should be happy and glad that we did the background. Okay, and it is now easier for us to attack whatever relevant costing question that comes by. Okay, so prepare a cost statement using relevant costing principles showing the minimum cost that TICO should charge for the contract. Make detailed notes showing how each cost has been arrived at and explaining why each of the costs above has been included or excluded from your cost statement. So we need to actually have some systematic way of presenting this information. We have to prepare a cost statement, all right, using relevant costing principles to show what relevant costs shall we charge for this contract. Okay, remember the idea of relevant costing is for us to remain competitive. Otherwise, if we just include unnecessary costs in a contract, we are not going to get those contracts. We would be beaten out. Remember, most countries are employing what are called procurement policies, which means there should be some competitive bidding process that takes place, and usually the suppliers who are a bit cheaper but not compromising quality. You might be having good quality, but there are also other suppliers who are giving products of high quality. So you need now to capitalize on your relevant costing principles so that you remain competitive in as much as you are producing quality products. All right, that's the idea. So in this case, we are given this information for telephone call. We need to just read through the question together and then see what will be happening. However, what I recommend is that you just have to first read the first part of the question, the first paragraph, one or two paragraphs, and get the general gist of the question. Now, the telephone company TCO is a company specializing in the provision of telephone systems for commercial clients. There are two parts to the business: installing telephone systems in businesses, either first-time installations or replacement installations. Then supporting the telephone systems with annually renewable maintenance contracts. TCO has been approached by a potential customer, Pushco, who wants to install a telephone system in new offices it is opening. So a new client called Pushco has approached TCO because they want this. While the job is not a particularly large one, TCO is hopeful of future business in the form of replacement systems and support contracts for Pushco. TCO is therefore keen to quote a competitive price for the job because they want to just win over this customer with this installation. They are not expecting to charge much. They just want to charge the minimum competitive price, which so that they win over this customer and then start to get or to gain more revenue streams from other services which they can give to this particular client. The following information should be considered. All right, so that's the information which we need to consider now for the purpose of our relevant costing. Okay, now one of the company's salesmen has already been to visit Pushco to give them a demonstration of the new system together with a complimentary lunch, the cost of which totaled 400. Now, the question is this cost a relevant cost or not? Because we are told it has already been incurred. All right, is that a relevant cost? All right, remember we are required to determine if what the cost item should be to be included in this particular contract, and whether the amount should be considered relevant or not. All right, so we have to be very systematic, and it is advisable to come up with a table. And in the exam, we are going to be given a word processing application. All right, you'll be given that application on the computer screen, so do not worry. However, in this case, I've actually improvised using the Microsoft Word application. Okay, so let me just try to have a table here. All right, be with me. My computer is a bit older. Okay, it's a bit old. So let me just try to have a 4-column table. Okay, and we can label the columns. Okay, let me just try to put this thing in order. Just a minute. Okay, so our first column, ladies and gentlemen, should be let us just call this one the cost item. Okay, cost item, and then we have see my computer what it's doing now. Oh man, what is happening? Oh man, I'm delaying you guys. I'm sorry. Oh, what is happening? Okay. Oh man, oh man. What is happening again? Oh, oh, oh. Sorry. Okay. The cost item can leave this page for, this column for workings. All right. And then we need to see the result. Okay. The result could be the amount or the amount relevant from your workings. And then why do I consider it to be relevant? Why? Including or excluding the item or cost. Okay. Now we then have to get back to the question and attack it in a systematic way. Okay, let's just try to attack it in a systematic way. We are seeing the salesman there. Okay, so we just slot the information in our answer sheet. Okay, the salesman is the cost item. Salesman. Okay, the salesman, it is said from the question, one of the common salesmen has already been to visit Pushco to give them a demonstration of the new system together with a complimentary lunch, the cost of which totaled $400. This guy has already been to the client, so this is actually for decision purposes. This is a sunk cost. So we come here and say 0. Why? Because the cost has already been incurred. Okay, i.e. this is a sunk cost. Therefore, $400 is excluded. You just have to be precise. Do not worry about complex jargon. Okay, this is not a language exam. All right, so there's nothing beneficial in getting too pedantic about it. Okay, so this is how you are supposed to answer such an item. Let us go to the following item that comes in the exam. It is not a must for you to attack these points or these paragraphs in their order. You may just start with the simple ones as you proceed. Okay, but here I'm just doing it for the purpose of time. Okay, and teaching. All right, we have got this issue or this second issue here. The installation is expected to take 1 week to complete and would require 3 engineers, each of whom is paid a monthly salary of $4,000. And we have already pointed out that no the cost. They are going to be paid whether this contract passes or not. The salaries of these gentlemen is going to come. So the engineer's salaries should be considered as irrelevant. So let's talk of the engineers. Okay, let's finish the paragraph. We've noted irrelevant. Then the engineers have just had their annual renewable contract renewable with Chico One of the three engineers has spare capacity to complete the work, but the other two would have to be moved from contract X in order to complete this one. Contract X generates a contribution of $5 per engineer hour. Okay, there are no other engineers available to continue with contract X if these two engineers are taken off the job. So it would mean that TICO would miss its contractual completion deadline on contract X by 1 week. So if we take these guys from what they are doing right now at contract X, it means that the contract X is going to be delayed by 1 week. Okay, there's going to be a delay of 1 week. As a result, TICO would have to pay a one-off penalty of $500. Since there is no other work scheduled for their engineers in 1 week's time, it will not be a problem for them to complete contract X at that point. So if they come and do the work, it means that the contract X is going to be delayed. Okay, so there is no lost contribution there. There is no lost contribution, but the delay is going to expose this company. Okay, it is going to expose this company to a penalty of $500. So the penalty is actually the relevant issue here. All right, this one is relevant. So we get back to our answer sheet and say engineers. Okay, engineers, $500. Okay, $500. Only the $500 penalty is relevant, as there is going to be a delay on contract X, which is an obligation to be met. Only the $500 penalty is relevant, as there is going to be a delay on contract X, which is an obligation to be met. Okay, we are going to meet this obligation of paying the penalty if we want, if we are to finish the contract X later on. However, the normal salary is a fixed cost. Is a fixed cost that should be excluded or is irrelevant. Okay. Okay, I'm trying to find this present paper of mine. All right, here it is. Fine. We then have to proceed to part 3. TICO's technical advisor would also need to dedicate 8 hours, okay? And let me try to rewrite, to erase that. Would have to dedicate 8 hours of his time to the job. He is working at full capacity. So you would have to work overtime in order to do this. He is paid an hourly rate of $40 and is paid for all overtime at a premium of 50% above his usual salary. I want you to try this, and then you have to show me what you have obtained later on. Okay, I hope you have done your part, and whatever answer you have obtained, let us now flow together. All right, this advisor, we are told that he needs to dedicate 8 hours, or she needs to dedicate 8 hours of his time to the job. He is working at full capacity. So if we are working at full capacity, it means that whatever we are going to offer to this other job, it is actually going to be a relevant cost. So we are going to work extra time. We're going to work overtime, all right, to attend to this new contract. So those 8 hours are relevant, okay? They are relevant. So the cost of those 8 hours, whatever is going to be paid, is relevant. So he is paid an hourly rate of $40 per hour and is paid overtime of 50% above the hourly rate. So we are going to say in our answer, this one is our technical advisor, yes. So we are going to say to our answer sheet, technical advisor. It's a cost item there. The working portion, we are saying he's working 8 hours, 8 hours, okay, multiply by the rate per hour is $40. I'm still remembering it correctly. That's $40 multiplied by the overtime and the basic hour rate. Okay, so he's being paid at 50% above the basic hour, so that's 1.5. All right, and we should get, let me take this calculator of mine. That's 8 hours, 8 multiplied by 40 multiplied by 1.5. Okay, and that should actually be the cost for this particular job with respect to the technical advisor. So that's 480. Okay, and we come here and say the technical advisor has no spare capacity. So whatever extra hour he works on the contract is a relevant cost. All right, this means $480 is relevant. Okay, We go to the next, and the question should lead us. So whatever item which you have done, you need to indicate that you are done with that. Okay, we are done, we are done. And in the exam, you just have to fly. All right, 2 visits would need to be made by the site inspector to approve the completed work. He is an independent contractor who is not employed by TCO and charges Pushco directly for the work. His cost is $200 for each visit. Now, this is when you are under exam pressure, you are highly likely to make a terrible blunder here. Okay, this is actually a short paragraph, but a trick one. All right, this guy is not being paid by TCO, right? He's not being paid by us. All right, so how can we include the cost of whatever benefit he is getting from our client? Obviously, this cost, this $200, is irrelevant for the purpose of pricing our contract. Okay, so even if this guy is needed there, that's his business with PICO. All right, so that's not part of our contract because we are not the guys who are going to pay him. So we come to our answer and say, what's his name? Let me see. Site inspector. Okay, site inspector. Site inspector. Okay, 0. The cost for the site inspector is irrelevant as TCO is not going to pay for those visits. Or for his visit. These are met by the client push call. You are done, you go to the next, because in the exam there is no time to dilly-dally. No time to dilly-dally. All right, what's the next item? TCO system trainer would need to spend 1 day at Pushco delivering training. He is paid a monthly salary of $1,500, but also receives commission of $125 for each day spent delivering training at a client site. So, like I said, the normal salary for whatever guy, whatever officer involved is not going to be a relevant cost because he is going to be paid that salary whether he does participate in the contract or not. So this one is irrelevant, but this one is going to be relevant. So how many days are we talking about? Needs to spend 1 day at Pushco. So that's 1 day allowance or commission. So this is the trainer. So you say system trainer. Okay, system trainer. System trainer, 125. Okay, $125. The trainer normal salary is a fixed cost. The trainer's normal salary is a fixed cost, which is irrelevant. However, the commission should be included in the costing of the contract. Okay, I need to put more boxes to mine. Okay, I think they are now enough. All right, let us go to the next part. Like I said, in the exam, you have to be flowing. All right, we are at telephone handset. 120 telephone handsets would need to be supplied to push call. The current cost of these is $18.20 each. Although Tico already has 80 handsets in inventory. So this company already has got 80 handsets in inventory. These were bought at a price of $16 each. The handsets are the most popular model on the market and frequently requested by Tico's customers. Wow. So the trick bit here is that how do we treat these items in the relevant costing arena? Okay. Okay. Now, there is one trick you need to grasp when you are dealing with questions which have got to, anything to do with materials. Okay. Now, here we know the client requires 120 telephone handsets. All right, that's a fact. And then we are also told that this particular client, while this particular client requires 120 cables, we already have 80, handsets available. All right. So we need to ask ourselves, do we have the materials at hand? Okay. If we do not have the materials at hand, then we have to buy those materials. But the contentious issue is, at what price are we going to record as a cost to us? Shall we record the current price or the price at which the materials were bought? As a relevant costing principle, you have to buy those materials at current cost. Okay, so you're going to cost whatever. If they are not in stock, you have to buy them at current cost. All right, but if they are in stock already, you have to ask yourself, are those materials frequently used or frequently required for the purpose of our business or our normal operations? If they are frequently required or they are frequently used in our production processes, then it means that we need to replace them. Even if we use the ones which we have currently, it means we have to replace them. So we replace them at what value? The replacement cost is actually the current cost. Are we together, ladies and gentlemen? So this is how we are supposed to proceed with this particular question. You're gonna say to your answer. All right. Let me try to do this. Okay, this is our answer. Now, we're going to say telephone handsets. Okay, telephone and sets. Okay, these are the telephone handsets we are going to need. All right, what's going on? This computer of mine can easily black out. All right, so let me just finish. Now, we have got 80 already. Okay, but what is required is 120 handsets. So we need to say 80 plus 40. And this should be 120. Okay, multiply by the current cost. And the current cost, ladies and gentlemen, was how much? The current cost was $18.20. Okay, that's the current cost. All right, that was involved. So if we use our calculator, we should get, let me try, that's 120 multiplied by 1820. That's 2,600 and 120 multiplied by 1820. 2,184. Okay, 2,184. That's the value we are talking about. And then we have to come here and say the historical cost of the items, that is the price at which they were bought is irrelevant. Okay, is irrelevant. I include or TCO should include the current price. For both the items not in stock and those which are in stock but are regularly used or required. We are told by in the question that these items are regularly used by TCO, so they have to be replaced the frequently or regularly used, the frequently used handsets would require a replacement. So the current cost should apply. Okay, we are done there. We then have to go to the next one, the next part. TCO would also need a computerized control system. So the client needs a computerized control system called Swipe 2. The current price of Swipe 2 is 10,800. Okay, the current market price is 10,800. Although TCO has an older version of the system, Swipe 1, in inventory, which would be modified at a cost of 4,600. TCO paid 5,400 for Swipe 1. This one is, remember, it is a historical cost. When it ordered it in error 2 months ago and there is no other use for it, the current market price of Swipe 1 is 5,450. Right? That's the current market price for Swipe 1, the old version which they have in stock. Okay, although if TCO had tried to sell the one they have it would be deemed to be used and therefore only worth 3,000. So you can see from this analysis that the 10,000 for 800 for swipe 2 is relevant. Yes, it's relevant, but only if the other option is expensive. All right, so 10,000, you can just give it a tick for now, but you need to consider if the modification alternative is not going to be expensive. How do we know that? How do you know if the modification alternative is going to be expensive or not? We say, what is the cost of modification and what is other contribution which we could have lost along the way. We are told here that if we sell, okay, if we sell, we are going only to recover 3,000. Okay, all right. So if we modify the item, we are not going to sell it. All right. If we modify the item, we are not going to sell it, but we are going to modify the item and give it to the customer. So we are going to incur expenses of 4,600, but we are going to lose the contribution of 3,000. We are not going to sell it anymore. So we are going to lose the revenue, rather. It is the revenue we are going to lose of 3,000. So the cost of modification, let us go back to our answer and say, this is the computerized system, okay? Sorry. Computerized system, computerized control system. The computerized control system okay, cost to buy, we are told it is from the question, it is from the question here, this item, that's 10,800, okay. This pen of mine, okay, it's highlighter, okay, 10,800, all right, and then the cost of modification is 4,600, and the lost revenue, we can't sell it anymore, is 3,000. These are the relevant costs we have to compare, all right. So I mean the relevant cash flows we have to worry about. So we say the cost of buying, the cost to buy or of buying in, the computer starts again, that's 10,800, okay. And then the cost of modification, the cost of modification, we are having 4,600, okay, 4,600 plus lost revenue. You can't sell it because you are modifying it, so you can't sell it, so you are going to lose 3,000, okay. So this means the modification itself, the modification exercise has costed 7,600. Okay, that's the cost of the modification, all right. So remember, we want to remain competitive in our pricing. So which cost shall we consider? Which cost? Shall we consider the cost of buying? Okay, shall we put the cost of buying you a bit cheaper? Otherwise, we are not going to get the bid. So we use 7,600. This is the cost. All right. So the relevant cost is 7,600, which is cheaper for TCO to be competitive. All right. However, let's talk of the costs which we ignored, because the examiner says when you ignore something, tell us why you have ignored it. Okay. The 5,400 you are seeing here is an already a historical cost for the item. I mean the cost at which this item was paid for. All right. And then we have got the current market price of swipe 1. Okay, the current market price is actually not applicable in this situation. All right, it's of no use to us. Okay, because this swipe 1 was bought in error and there are no uses for it, and when it is being sold, the potential buyers are requesting 3,000. All right, so the 5.4 current market price is actually irrelevant to us for this particular decision. So we're gonna say, however, 5,400, the price at which swipe 1 was bought is irrelevant, as it is a historical cost. Then the current price of swipe 1 is irrelevant. Even if it is the current price, it is irrelevant because we do not want, okay, TCO does not need to replace or buy it. All right. To sell the already procured swipe 1 is fetching only $3,000 from potential customers, from potential buyers. So this is why these other two figures are irrelevant. You can see that they are actually not relevant to our decision. Now let us do, I think we are left with one part here. All right, number 8, 1,000 meters of cable would be required to wire up the system. The cable is used frequently by TCO. It is used frequently, okay, by TCO, and it has 200 meters. Okay, the cable is used frequently by TCO and it has 200 meters in inventory. So TCO has 200 meters of this particular cable in inventory. So what is required is 800 meters. Okay, the inventory had costed $20 per meter. All right, that's a historical cost. Again, remember, the current market price for the cable is $30. So this cable is frequently used, so therefore it is required and therefore it is relevant. So because we only have the 200, this 200 we have to use it, but we have to replace it. So the 200 is a relevant cost, as well as the 800 that needs to be bought is also a relevant cost. Excuse me. So you just have to go back to your answer sheet and say cable. The cable, all right, that's 200. The 200 that is there plus the 800 which is not there, or multiply by the current price. What is the current price for this cable? The current price is $30. Okay, $30. So you get back to your other sheet and say $30. Okay, and how much do we get? Be with this calculator of mine. Okay, that's 200 plus 800, that's 1,000, multiplied by $30, that's 1,300. Okay, right. You then tell these examiners 200 meters are in stock, but used frequently. And so need replacement. 200 meters are in stock but used frequently, so they need replacement. The 800 meters which are out of stock and should therefore be procured. Both, okay, thus a total of 1,000 meters should be purchased. Okay, should be purchased at the current price. So simply, the cost should be based on 1,000 meters at $30, which is the current price. Once you have done this, ladies and gentlemen, you then have to come to the answer. Okay, so you have to get the total relevant cost. Total relevant cost of the contract. You then have to add up everything in this column. Okay, in this column. right? The 500, the 1300, until you come here, and I'm sure we need to have something like, we say 1300 plus 7600 plus 2184 plus 125 plus 480 plus 500. That's 12,189. That's our value. That's the total cost for this particular contract, 12,189. Okay. We have been helped. It is my hope that you guys have been assisted. Okay. I also believe that I have also benefited from you guys because when you are supporting me by giving me the audience, then I would be motivated to continue following the passion. All right. By the end of the day, it is an issue of passion. All right. If you find the video helpful, you may also consider to consider buying me a coffee on the link provided in the description section there. You can also even do the good thing by subscribing to the channel. Okay, you can just subscribe to the channel as we continue with our learning phase. In the next video, we are going to discuss about risk and uncertainty, where we'll be talking about the risk preferences of investors and so forth. Okay, those are important topics which are also part of this ACCA PM syllabus. All right, so I hope you have been assisted with this presentation. Ladies and gentlemen, until we meet next time, may the good Lord continue to bless you. Like I said, you can do the right thing by subscribing to the channel, sharing the video with your peers and friends or other students who are studying the ACCA PM module, so that they also benefit, and the school, the Transcal Consulting Services School, where we are based, should also grow. Okay, like I said, I am signing out. Don't forget to click the notification bell again after subscribing. Goodbye.